Well, good morning, everyone, and I'm delighted to welcome you to the latest in the Compeer series of webinars. And today we'll be addressing the topic of compliance, or more specifically, the future of UK regulation for the UK wealth industry. Now, for anyone who's attended our webinars in the past, I'm sure you've heard me say many times about how resilient this industry is and how it's produced remarkable results in all market conditions. But one area where it continues to struggle is cost control, as costs continue to increase, often at a similar or even faster rate than revenues. And so it's applying some pressure on profitability. Now, one of the key drivers behind the increase in costs has been the need to comply with new regulations, and so the increase in compliance costs. And following the recent issue of the Dear CEO letter by the FCA in September last year, it appears there are more regulations on the horizon, and so it's likely these costs are going to continue to increase. And so these new regulations will form a major part of our discussions today. Now, the webinar today is in two parts. So we've got a couple of presentations in the first half, and then the second half we have a panel discussion where I will be putting it open to the audience to pose your own questions. And you can do that via the Q&A button at the bottom of your screens. But without further ado, well, let's get started with our first presentation. And I'm delighted to introduce Therese Chambers, who is the Director of Consumer Investments at the FCA, and today is very kindly going to be sharing with us her views as to what the regulator expects from wealth management firms. So, Therese, very much welcome to you, and I'll now pass over to you.
Thank you, James, and thank you, Compeer, for giving me the opportunity to talk to all of you today. So I'm going to cover our most recent publications and initiatives, but before I get into the detail of that, I just wanted to remind you of our most recent communication relating to Russian sanctions. I'm sure you will all already have taken note of this, but our key expectation of you is that your financial sanctions, systems and controls should be capable of being adapted in line with both the recent changes and any changes that the UK may make at short notice. So let me then move on to our recent publications and initiatives. I'm sure you will feel that we have been giving you plenty to read over the past few months. We've had the Consumer Investment Strategy, which we published in September. We've had the CEO letter also in September. And in December, we published our second consultation paper on the new Consumer Duty. And I want to cover aspects from all of those with you today. I'm going to start with the Consumer Investment Strategy. Now, there's a major problem within UK financial services. Surveys suggest that up to 66% of the UK population do not believe that our financial sector acts in the best interest of society. And what our strategy is aimed at doing is rebuilding that consumer trust in the UK personal investment industry. The strategy has four key pillars. First, we want consumers to feel supported in investing in mainstream investments like stocks and shares ISAs. Second, we want consumers only to access higher risk investments knowingly and with full understanding of the risks involved. Now, for you, the suitability obligations on discretionary management should control this, should control it strongly. But where you operate an execution-only service, your appropriateness assessments should be robust. Third, we want consumers to be protected from frauds and scams. I'll pick up on that a little later. And fourth, when things go wrong, we want consumers to know how to get redress and for the cost of that redress to be met by firms in a fairer and more sustainable way. Now, I want to pick out next some of the themes from our recent Dear CEO letter. The first theme I want to call out is the theme of data. Our regulatory strategy will be increasingly data-led, and we expect you to maintain appropriate systems and controls to facilitate the production and reporting of high-quality data on a timely basis. This is, of course, not just so that you can meet your regulatory information requirements, but you also need to have good data in order to run your business effectively, and your board need to have confidence in the overall control environment that should be giving assurance that they're meeting their obligations. Now, my division, Consumer Investments, is responsible for the prudential and conduct supervision of over 6,500 firms. And to accomplish that effectively and efficiently, we need good quality data and good data tools. And it may surprise you to know that we currently gather through regulatory reporting much less information on the activities of wealth management firms than we do for many other areas of financial services or other areas of consumer investments. So wealth management and stockbroking firms will, in the next few months, be receiving an information request from us. This seeks to give us more information in the areas where we're concerned about poor customer outcomes, such as payments to introducers, your financial promotions activity, and your use of investments subject to restrictions on distribution. As part of the strong management of your business, we would expect you to have this data readily to hand. A draft of our request has been shared with PIMFA for their thoughts, and we will pilot it first with a few firms before sending out more widely. The second theme I wanted to pick up is that of culture, which is a perennial theme in conversations that the FCA has with firms. But the reason for that is simple. Time and again, when we look at the root causes of major conduct failings within financial services firms, we find that a poor culture within firms was key to that. So just one example of a recent intervention against a wealth management firm, which ended up in administration, that firm suffered from a number of indicators of poor culture: a dominant CEO, a high turnover of senior staff in critical functions, conflicts of interest between senior management and investments held in portfolios, and a lack of transparency and cooperation with us and other regulators. We expect firms to take action to foster a healthy culture which actively seeks to prevent harm to consumers or markets, and we should not be seeing instances of those types of indicators that I have just listed for you. And the proposed consumer duty, which I'll pick up shortly, is another step in our drive to generate better cultures in financial services firms. Now, the next theme I want to pick up on is around frauds and scams. As I mentioned, high-risk investments are a key aspect of our consumer investment strategy. And in recent years, we have had to devote considerable resource to dealing with a small number of wealth management firms, such as Greyfriars, SVS, Beaufort Securities, who invested client money into mini-bond investments. Many of those should never have played any part in the portfolios of retail clients. Now, I know how much wealth firms rely on their reputations for integrity when seeking to attract and retain customers. And your core service is the discretionary management of the bulk of a customer's wealth. The customer gives you permission to make investment decisions without consulting them. This requires the customer to have a very high level of trust in you and what you do. And the bad actors in the wealth management industry not only damage their own customers, they also damage the reputation of the entire industry and your relationship with your customers. And of course, it results in you having to fund FSCS compensation claims. So raising standards is in everybody's interest. And we expect that you will manage your client portfolios to always ensure overall suitability. That's not controversial, that's your day job. We expect that where portfolios include high risk or unregulated investments, you have due diligence and you are able to fully justify that investment based on your client's risk profile. You should at all times be alert to the potential for any high risk investment to be a scam. We expect you to have robust systems and controls, and we expect you to make us aware if you identify a firm or individual who might be involved in wrongdoing or an investment product that you have concerns about. Now, let me turn very briefly to the proposed consumer duty. This is intended to mark a significant shift in what we expect from all firms that provide financial services to retail clients and the treatment these clients should receive. And it's part of our continued drive to move firms to being more proactive in delivering a healthy culture. And it ties into the consumer investment strategy as part of the aim of giving consumers greater confidence in the industry. We want them to know that the firms they deal with can be trusted and the products and services that are promoted to them have been designed to deliver good outcomes for their financial needs. I'm sure you'll all be very familiar with the 4 outcomes that we have set out around communications, around products and services being designed to meet the needs on consumers, on customer service, meeting the needs of consumers, and on the pricing of products and services representing fair value for consumers. Now, I recognise, of course, that for many of you, a very high level of personalised customer service and customer communication is a key part of your offering. And so hopefully this will not represent a step change for you. But there will be questions that you will need to think through. For example, on fair value, have you considered the total investment cost paid by the consumer relative to the benefits offered by the product or service? And are there any subsets of your clients where fair value may not be being achieved? And on product design, have you identified a clear target market for your products or services? Are they optimized for specific consumer needs? For example, for clients in accumulation as well as decumulation. We think an outcomes-based consumer duty that focuses on tackling the key drivers of harm is a better, more flexible and more effective way to regulate. And consumers will only build trust in the sector through positive outcomes and experiences. So I will just now move on to how the FCA is and will be changing its supervisory approach. The consumer duty links very clearly to how we will supervise firms. And the FCA is transforming its supervisory approach to be more data-led, more agile, and more assertive. Becoming a data-led regulator means profound changes in the way we work as a regulator. We've made a huge investment in our capabilities, how we collect data, how we use it, and the way we turn it into market interventions. Our core supervisory activities will remain. We will continue with multi-firm work, and we will continue to collect data. But the nature of our engagement and the data we collect will be focused more on consumer outcomes. And this is the language you can expect to be hearing from us. We will be seeking evidence from firms of what consumer outcomes are being achieved and how firms are assuring themselves of that. And the forthcoming information request to wealth firms will enable a more data-led approach to our supervision, which will support our intention to be more agile and more assertive. And where we see consumer harm taking place, we will seek to take quicker and stronger action. We will focus action on firms that we feel are causing consumer harm, and we are applying a bolder risk appetite in dealing with serious misconduct. And we intend to deal more assertively with firms and the accountable senior managers within them. So let me just wrap up those remarks. In summary, the FCA is changing towards a more data-led and a more assertive approach to supervision. The consumer investment strategy highlights how we will deal with the most significant harms that face retail investors. The new consumer duty marks a significant shift in what we expect of firms, placing good consumer outcomes at the heart of all firm activity. And our recent letter sets out our greatest concerns within wealth management firms. Look out for that information request from us to your firms in the coming months. A data-led supervisory approach means that we need more data about you and your activities to identify where we should be focusing our supervisory resources. Thank you for your attention. I'll hand back to James.
Well, thank you very much, Therese, for that insightful presentation and for the extra clarity it provides to our listeners today. And so we'll now move on to our second presentation, and it wouldn't be a Compeer webinar without us sharing some statistics with you. So I'm now delighted to introduce my colleague, Tom Thwaites, who's going to be sharing some recent research findings from a survey with heads of compliance. So over to you, Tom.
Thanks, James. And thank you everyone for joining us this morning. So as James mentioned, I'll be running through the results of our recent research, which we've conducted with heads of compliance, which quite a few of you have kindly taken part in. So I'd like to thank you very much for your input. Now, the survey itself takes a look at the ways in which compliance departments are performing and evolving, while also focusing on how firms are responding to the FCA's recent Dear CEO letter and some of the points Teresa has just discussed. So if we move on to my first slide, we can begin by taking a look at the level of efficiency of the typical compliance department when dealing with different projects. So first up here, I've analysed some of our benchmarking data, and by taking compliance department costs as a percentage of total revenue, we can gauge the efficiency of the compliance function over time. And what we find is that the level of efficiency has remained fairly flat since 2015. So compliance costs haven't significantly outpaced revenue growth over this period, which is a promising sign. Now, I will highlight that this measures only the direct cost of compliance in relation to revenues and does not take into account any indirect costs. But in fact, we find that 1 in 4 firms say as much as 80% of compliance is taken outside it happens outside the compliance department, meaning that the true cost of compliance could be significantly higher than what our figures show. And in terms of their perception of their efficiency, we find that 92% of firms do believe that in the last 5 years, their compliance processes have become more efficient. And with the sheer amount of work they've had to process, this has forced them to adapt and become more efficient in order to survive. Now, despite this, we see that less than half of the industry sets a formal compliance budget. This relationship does correlate with the size of the firm, as the large players are more likely to set a formal budget. The issue the smaller firms struggle with is that they're held to the same standards and therefore have to meet the same requirements as the larger firms, often costing them a similar amount to do so, but without the luxury of the capital and the resources that the larger firms have. And given our previous research has shown the high percentage of firms who have consistently gone over budget with projects such as MiFID II or GDPR, this figure is no surprise, as many firms admit they just end up having to pay what they need to pay in order to comply, rather than being able to strategically forecast a suitable budget as you would with other departments. So if we move now onto my next slide, we can see how firms are planning to further improve efficiency moving forwards. To look at the changes required over the next 2 years, we began by asking firms about their expectations over the pace of future change. And with the FCA's intentions laid out at the end of last year, it's no surprise to see that firms are expecting the pace of regulation to remain high, even in comparison to the last 2 years. And when asked to rank their priorities in terms of how they will improve their compliance department moving forward, 42% of firms place streamlining workflows and processes as their top priority, while a third are focused on system upgrades. And despite 92% of firms thinking their department has become more efficient, this shows the extent to which major overhauls are required to continually evolve in order to keep up with the future pace of regulation. As attracting new staff was the lowest rated priority, it shows a good sign for recruitment strategies, as firms seem the most content with the quality of talent they have working for them. While these staff will need upskilling to cope with the future changes, it displays the confidence firms have in their staff and the awareness to the issues within their systems and workflows which need addressing. So now we've seen a little bit of a background about the performance of the compliance function. On my next slide here, we can take a little bit more of a look in detail at how firms are responding to the first major theme brought up in the FCA's recent Dear CEO letter. So my next slide, please. Now, the FCA have set out their goals to clean up the amount of fraud, scams, and market abuse within the industry. So to find out how wealth managers reacted to this, we asked them to rate the effectiveness of certain tools to reduce the amount of market abuse. Awarding points on their ratings out of 5, I've taken the results here and converted them into a percentage to represent the proportional effectiveness of each factor. Now, the results show that firms feel that more regulation is the last thing that will help clean up market abuse. While I appreciate this isn't exactly breaking news that wealth managers are against further regulation, but instead it does highlight their attitudes towards the importance of additional training and educational resources for both staff and clients. Now, this isn't pushing the blame onto the people and away from the firm, but this shows how firms appreciate that regulation can only go so far in preventing these such issues. Success will therefore require appropriate training and education to be provided, to avoid these scenarios from occurring. Alongside this, failures in the suitability process is one area in which the FCA believe causes the most problems. Our research shows that there is a big divide in how firms approach suitability reviews, with just under half reviewing suitability on an ongoing process, while the rest go through a formal review once per year. And despite the FCA's call to tighten up this process, as they don't believe enough is being done currently, only 7% of firms have plans to increase the frequency and the level of detail in their review process. And as younger demographics emerge, there's a need for wealth managers to adapt to broader asset classes and more risky investments such as cryptocurrencies. And so the range of risky investment opportunities is only likely to increase, and therefore the suitability process is more likely, whereas it's going to need to adapt even further. So if we move now on to my next slide, and we can take a look at what is being done to increase the financial resilience and reduce disorderly firm failure. Now, the industry has seen a significantly higher level of volatility in the last couple of years, largely due to COVID, and in some part to Brexit too. And I know everyone's sick of hearing about both of them, but sadly they're here to stay for the foreseeable future at least. Now, the industry has somewhat steadied itself. However, there is still a large portion of the industry in trouble, which places firms in an unstable financial position and increases the risk of harm to consumers. The issue, however, is not a new one, and is not solely the result of Brexit and COVID. And yes, these may have exaggerated these problems for some firms, but the issue of loss-making firms has a long history within the industry. For the industry as a whole, profits have remained strong, but have slowly been declining each year. However, the average margin stands at over 20%, and the issue lies within the spread of profits across the industry. The graph here represents firms of all sizes across wealth management, private banking, and exo stockbrokers, and shows how, on the one hand, we have around 9% of the industry making over a 40% margin, while on the other, we have around 20% who are making a loss. Now, to tackle this, the FCA have put capital reporting requirements in place, alongside IFPR and MiFID II, but there still seems to be a split in firms' opinions in how regulation can impact firm resilience. Now, the majority, almost 70%, believe that regulation will have either no or very little impact here, and that the cause for these loss-making firms is not a direct effect of a lack of regulation. While the remaining firms are evenly split between those who believe regulation will have a positive impact and those who see it as making things worse. The challenge for the FCA is obviously to find a common denominator of the loss-making firms and find a way the regulation can fix this without damaging the profitability of the rest of the market. So if we now move on to my final slide here, we can look at the FCA's concerns over costs and charges. So over 4 years ago, MiFID II was brought in with the aim to ensure all consumers receive clear communication with regards to information about the costs they pay. But the FCA are still not satisfied with the impact this has made and how some firms still deal with their clients. When it comes to disclosing the costs and charges, there is not a clear, proven way firms have found to simply let clients know the costs of their services. So it looks like the FCA have some reason to be concerned. So we asked firms to list the ways in which they disclose their charges to their clients, and the chart here shows the proportion of firms who use each channel. The most common, and probably the most expected, is on the client's quarterly or annual reports, although still just over 20% of firms did not report to using this method. As a tool to provide a higher degree of self-service, it's surprising to see less than 20% of firms use their portal as a way to let clients do their charges. However, as many firms are in the process of overhauling their portals, I would not be surprised to see this figure jump significantly higher over the next few years. Now, less than half of the industry publishes their costs on their website, and only around half of firms ask their advisors to run through charges with their clients. While this only shows how these methods are offered and doesn't provide insight into how well clients respond and understand their charges, the clients may not want to be bombarded with cost disclosures if they fully understand them in the first place. However, with such low adoption rates to what could be expected to be the main methods of disclosing costs, it doesn't surprise me that the FCA are concerned by the number of clients who are unaware of their true charges since they are seemingly not published thoroughly enough across the industry. So on that note, I will wrap up my presentation, and I'd like to thank you all again once for joining us. I hope you enjoy the rest of the webinar, and I'll now pass back over to James.
Thank you very much, Tom. And I should point out that after the webinar, we will be sharing these slides, so you will have full access to all of the results that Tom has presented today. So we've heard from the regulator as to what is expected from firms, and we've also heard how, in general, wealth management firms are viewing the upcoming regulations. But to expand on this further, I'm now delighted to kick off our panel discussion, where we'll hear some of the first-hand views. So as mentioned at the start, if you would like to pose a question to our panel, please use the Q&A button at the bottom of your screen, and I'll look to get as many of these questions answered as possible. And now, joining me today, I'm delighted to introduce, we have Penny Rooney, the Chief Risk Officer at Killick & Co, Louise Stanway, the Head of Compliance at Ruffer, and Duncan Taylor, the Head of UK Wealth Management at Canaccord Genuity Wealth Management. So very much welcome to each of you, and thank you very much for your time today. And so I'll get us started with our first question. It's more of a general one, and I'll start with you, Louise, on this one. So what is the biggest regulatory headache for your firm currently?
Thanks very much, James. I feel because of Teresa's presentation, I should say consumer duty, but actually I'm going to say something different, although consumer duty is up there. I think one of the challenges actually is ESG, because there are so many parts to it. One could describe it as an octopus, but I think it's got more than 8 different parts to it, so an octopus isn't quite good enough. And also with ESG, there's not just regulatory change, there's industry initiatives, etc. So ESG, I think itself is quite a challenge because of the different moving parts, and to get one's arms around them, and also all the different areas of the business that it feeds into. Another challenge we have, and this is because we still have a foot in the EU, is the timing differences between the EU and the UK are getting more frequent. When we were in the EU, we were all doing everything at the same time. Some specific examples. It's great that in the UK we've binned RTS 28, but they haven't quite done it in the EU yet, so we need to do that. And actually on the ESG front, for example, we have the delegated acts for the MiFID, UCITS and AFMD changes in relation to suitability in ESG. That comes in August this year in Europe, but actually in the UK we're still waiting to see. So if you work on things on a kind of a firm-wide basis, that timing gap between what they're doing in the UK, what we're doing in the UK, and what we're doing in the EU, it's also an interesting challenge. Not just the timing, obviously, is the regulatory divergence as well. It's the price you pay for being in more than one jurisdiction, but it's interesting that it's an interesting challenge.
Thank you. And Penny, is it similar for you at Killick?
I was going to talk about 2 different things, actually. If you're my MLRO at the moment, then sanctions are the biggest headache right now, and keeping up to date with those and responding to those. Not so much for individuals. Fortunately, we don't have that many non-UK clients, but just in terms of stock restrictions and trading restrictions, that's an immediate headache that we're dealing with. The other point I was going to mention was consumer duty. Therese said, as a wealth management industry, focus on our clients and good client outcomes is absolutely essential to everything we do, and we wouldn't have businesses without that. So on the face of it, it might seem like there's not so much to be concerned about compared to banking or insurance sectors, perhaps. But actually, some of the detail of what we might need to do in order to fulfill the requirements of consumer duty, I think, are quite far-reaching. In particular, there's a requirement to have a look at your processes from a customer perspective. I think we tend to look at processes usually from the point of view of what makes life easier for us and more efficient for us as a business. This is actually asking you to look at it from a completely different angle. And in order to do that, you're going to need input from client-facing staff. You're probably going to need to have some engagement with clients as well to understand where their frustrations might be in certain processes that you have. You've got your compliance and risk teams need to be there to ensure that you're meeting obligations and managing risks if you're thinking about changing anything. And of course, then you've got that to go through your governance structure, and probably some communications and some training as well. So for me, I think that particular aspect of the consumer duty, even though on the face of it, it might seem like, well, we're doing all the right things anyway, I think that's possibly quite an onerous headache that we're going to have to deal with over the next 12 months.
Thank you, Penny. And last but by no means least, Duncan, how about at Canaccord?
Thanks, James. It's great coming on last because I can just reflect what the other two speakers have put much more eloquently than I can. But I was going to mention ESG as a big sort of long-term, and Louise has mentioned the octopus. It seems to me the biggest risk for wealth management firms, both risk in terms of regulatory risk, but also survival of the firm. And it touches absolutely every part of the firm, whether it's what you're investing in down to how you light your buildings and how you dispose of your lunch and stuff like that. So it's massive. Clearly, it's reflected in the society as well. I just think it is absolutely enormous for all of us to get our heads around that. And from a regulatory point of view, because some of it is in regulation, we in compliance are expected to lead that effort, and we simply can't. It's got to be a firm-wide effort. I was also going to mention consumer duty. Penny's talked in detail about that. FCA obviously expect a fundamental shift in culture. So they're expecting big things. Their cost-benefit analysis says they expect firms to spend a lot of money on this. When I've presented to our board, they've said, but we do all of this anyway, so it shouldn't be much of a problem. So there's already a mismatch of expectations between what the FCA are expecting from us and what we think we do. I'm not making any comments about who's right or wrong, but there's obviously a gap there that we need to fill. So every stage of our processes and every part of our organizational structure needs to be looked at. And that's a massive task for us. Whilst at the same time, FCA is going to apply its assertive supervision and ask us what we're doing, how we're doing it, and also look at how other firms are doing it and then put those standards on us as a firm. So it's going to be a real challenge, I think. And also, both Louise and Penny have alluded to unexpected things. So whilst we have the expected things that come out, we have unexpected things, and Russian sanctions is, well, in the scheme of things, it's not very relevant considering the conflict in the Ukraine. But for us, on a daily basis, the pressures that we have to face with that unexpected additional workload, and that's not just with sanctions, that's with FCA questionnaires, all the day-to-day things that can explode. So basically, I have a headache every day.
Well, obviously, sorry to hear about the headache. And obviously, there's a huge amount that firms have to comply with. And we've got a question from our audience here. Is there a link between the amount of extra regulation we're getting and the amount of acquisitions we're seeing? So some of the smaller firms are struggling in particular to keep up with the pace of regulatory change. And so, Duncan, starting with you, obviously, Canaccord have been very active in terms of acquisitions. Do you think it does put more pressure on the smaller firms?
Definitely. I'm not really commenting about the firms that we've been involved in with our transactions, but the cost of regulation has been increasing year on year ever since I've been in compliance. So I can't see that as changing, and smaller firms will have those cost pressures, which are quite substantial. And the other thing that the regulator has constantly done is look at big firms in particular in the first round of supervision, and then apply those standards to the smaller firms, which means the smaller firms have to gear up in terms of cost and resource and effort. So yes, that will only increase as far as I can see. And
Louise, would you agree?
Yeah, I would. I think it also makes it very difficult for a new entrant as well. You know, if you're new, if you want to set up a new firm and start from scratch, you know, you've got to start with a lot right from day one. And I think it's very difficult. You know, the regulator in the past has talked about competition in the industry, and the burden of regulation is is high and could be, in some instances, cause anti-competitive behavior, because you could end up, as you say, you have less new entrants, you have smaller firms struggling and therefore being bought out by larger firms. It's a really interesting dilemma.
And Penny, if I slightly rephrase it for you, because we've just had a second question come in. So is the M&A activity, where it's due to the volume of regulations and it's increasing, is that against the FCA's competition objective? So is it actually, do you think it's ultimately harming consumers?
I think that probably picks up on what Louise was just saying, that that it's harder and harder for new entrants to come in, and especially if you've got other firms being bought out by larger ones and swallowed up, then that's reducing availability of different types of firms for consumers to go to. I mean, our experiences, we've been going for about 30 years now. We were a small company. We're now a medium-sized company, and that development has actually been very challenging. Not only from a compliance perspective, but in terms of all of your governance and operational changes. And there are a lot of growing pains to be gone through while still trying to provide excellent service for your clients and remain as a profitable business. And I can completely understand why some smaller firms actually give up on that challenge and allow themselves to be swallowed up by a larger entity where they've got the economies of scale already. So I think Louise made a very fair point, and I think your questioner there has also raised a fair point about it reducing competition across the board.
Thank you. And if we now think about more forward-looking, so Tom's presentation, he mentioned about the rise in direct costs of compliance, and in fact, the figures are around about averaging 9% increase year on year. In fact, if we bring in the indirect costs, it's going at a far faster rate than that. So do you believe that this rate of growth is going to continue, or will it even potentially increase? So I'll start with you, Penny, on this one.
Definitely can't see it reducing. I think we've been hearing about the headaches ahead. We've been hearing from Therese that the FCA is becoming much more active in terms of its regulatory change and its demands on firms to provide more data. So I think we can definitely expect to see compliance costs continuing. And I thought it was interesting in the Compeer data, actually, that those costs aren't just within compliance teams, that the biggest burden of cost actually is across the business more widely, especially I think if you are implementing a 3 lines of defence approach and you're pushing more of those compliance responsibilities out into your first line.
And Duncan, would you agree?
Yeah, I agree. I can only see it increasing. I think compliance is so much more just doing business these days rather than compliance. So a lot of it is being done by other areas of business, but I can't see any change in that. And technology, the cost of technology is going to increase as well, whether it's from a compliance point of view or satisfying client demand for different types of technology is going to increase. So I can't see any downward trend, I'm afraid. And
Louise, is it similar view from you?
Yes, I mean, I think more and more regulation means there's more we need to do, and for that, it sometimes means additional staff members or it means additional systems. I thought the comment in the presentation was interesting about budgeting and kind of the ability to budget or not budget, and yeah, sometimes you just something comes up, you have to pay for it. I think one of those interesting ones, and it touches on something Therese mentioned, and that's the FSCS levy. We've just gone through our budgeting process, and one of the things that I find the hardest thing to budget is people say, right, well, how much are we going to have to pay the FCA this year? What are FCA fees going to be? What are FSCS fees going to be? And some I can nail easily because I know how much the FCA will charge us per assets under management. But something like the FSCS, which, as we know, can fluctuate dramatically year on year, that's something that is very difficult to budget for. And then halfway through the year, you get an alarming bill from the FCA, and you ask everyone to sit down before you hand over the piece of paper. And whether that sits in a compliance cost center or a firm cost center or whatever, it's not about which cost center it sits in. It's just, we do our best to try and budget and think about what are the things we're going to need throughout the year. But the FSCS continues to be quite a challenge, but I know that it's something that the FCA is aware of, they're looking at, and Therese mentioned that. But in the meantime, it's a challenge.
So staying with you, Louise, do you feel you're currently getting value for money in terms of what you're spending on compliance? And also, how do you therefore improve efficiency, or even how do you fund the additional costs of the regulations?
Yeah, value for money on compliance is a difficult one to measure. Do you measure it by, well, we haven't been fined this year, or when the FCA came to visit, they went away happy, or, how do for me, it's about trying to do what we need to do as efficiently and effectively as possible. That's not necessarily the cheapest way to do it. It's about finding a good way to achieve a good outcome for the business. And sometimes that involves spending money. So yeah, value for money on compliance is a difficult one, but ultimately it's about, the softer side is, do the business feel like they have got the support from the compliance function they need during the year? It's not just about, well, compliance spend was X% of total amount spend, and therefore that is good or bad. It's less binary than that. So quite a difficult one to look at, but we will always look to strive to find efficiencies where we can. So where we can automate, we'll look to automate. Where we'll look to use maybe tools that other areas of the business are using, which we can also use. So there are things we always look at to see what we can do to be more efficient, be more effective and cost effective, but it's not always about spending less money.
And Penny, is it similar at Killick, or are there other ways you feel you can improve efficiencies and get more value for money from the compliance department?
Yeah, I think Louise has made some really good points there. We're also looking at ways of streamlining certain of our compliance activities, maybe looking at some kind of compliance system to just make us more efficient as a team and therefore support the business better. In terms of costs within the compliance team itself, we're in a regional office, we're outside of London, so that brings some immediate, some apparent cost savings. The downside to that is a smaller talent pool to draw from in the first place. But again, on the flip side of that, people tend to stay with us longer. They don't move around so much. Although with hybrid working and remote working, that may change. So that's an area that we're actually keeping an eye on in terms of benchmarking compliance salaries and seeing, if people do become more mobile with the ability to take a London job without having to be in London 5 days a week, how that might affect us as a team and compliance costs for the firm generally.
Thank you, Penny. And Duncan, how about at Canaccord?
Yeah, I mean, that mobility thing is going to be interesting to see how that pans out. And in compliance, we always have this need to be seen. So whilst people can work from home, from a culture point of view, we need to be around the business. So it's going to be difficult, but it'll be interesting to see how that develops. I have to say, my team provides incredible value for money to Canaccord. I'll just say that as a headline. But we can always streamline processes, procedures. We may look at artificial intelligence, see if that helps. But clearly, whenever we look at new technology, sometimes it's always expensive and sometimes doesn't need less resource to operate. So we have to be mindful of that. But we're always looking, as any part of the business, looking at doing things more efficiently.
Thank you, Duncan. Now, if we move on to some of the more specific parts of the Dear CEO letter. So start with you, Duncan, on this one. So what steps has your firm taken to actively reduce the chances of fraud and investment scams that could potentially affect your clients?
Well, I mean, for me, that's a very difficult question. Proactively, what can we do? There isn't a lot from my experience. We can obviously make our systems robust as possible in terms of cybersecurity, data security, etc. We do all of those things, but clients still do get caught out by email takeover, account takeover, investment scams. And the best we can do there is really have constant dialogue with clients. We have a cheat sheet as to what they should do in the event of a fraud or scam. So we try and help them, guide them, point them in the right direction. And we will try and educate them as much as we can. Unfortunately, as we all know, fraudsters will always be a few steps ahead of any business. So it's difficult to preempt some of these things. And we've seen, again, recently how various cyber firms can infiltrate the highest security there is. So we're always on the back foot, I think, as a financial firm, but we do our best. But in terms of proactive things, it's really about education and dialogue with clients and helping them and understanding and listening to them, essentially.
Thank you, Duncan. And Louise, how about at Rafa?
Yeah, similar. I mean, we have all the internal controls and systems and controls. So, sorry, my light has just gone off. Oh, balance, I've got. Sit in the dark. We have all the internal systems and controls around payments and making sure that, you know, we have clients' bank details, hard-coded system, and there are authorized checks for getting them changed and things like that. The challenge is, to Duncan's point, is when it happens to a client, but in relation to other parts of their world, or it's people who aren't clients and someone is using Rafa's name to try and swindle someone out of money. And a lot of it is, you know, proactively, there's only so much you can do. You can be proactive with your clients to, you know, help message your clients, but it's very difficult for me to be proactive with someone with whom I have no relationship or with whom the firm has no relationship. And then you're very reactive, and it's similar to what Duncan says. You get the phone call saying someone using Rafa's name has tried to swindle me out of this. What can I do? And it's talking them through the processes, what they can do, who they can call, you know, their bank, action, fraud, etc. And that's the best we can do. I think in some instances it's extremely frustrating. And we do some other things. So, for example, we have had some issues with one of the platforms and one of the social media platforms, and we don't have an official account on that platform. So what we did is, any traffic that comes to our website from that platform automatically goes to our fraud article. You know, so that's an example of where we've tried to be proactive. So if anyone does get kind of, you know, does have a kind of an attempt, and kind of our website does sometimes be shown in the messaging that goes backwards and forwards. If they click on it, it will go, instead of to our homepage, it goes automatically to an article about fraud and what you can do to help protect yourself. So those are some of the proactive things we can do, but in some instances all we can do is be reactive, which is frustrating, and there are times when I wish we could do more.
Thank you, Louise. And Penny, how about at Killick? Anything else?
Yeah, I mentioned three quick things. So Therese mentioned in her talk about a couple of firms who'd got into trouble by investing in mini bonds. So one of the things we do is not invest in stuff like that. We're dealing with retail clients. We therefore stick with very mainstream assets, and hopefully that's one way to guard against those sorts of issues. Regular training for staff around fraud and scams, and reinforcing the procedures and why they're there and why they need to be followed at all times. And the third thing is, and Duncan mentioned this, that client emails being hacked is probably the major source of potential fraud incidents that we see. And so we are actually investing more in our client portal to try and reduce the reliance on email as a communication method, so that more conversations, interactions with clients take place over a secure environment.
Thank you, Penny. And actually, we just had a follow-up question from the audience. So when you receive a fraudulent request to pay monies to a bank account, once identified as fraudulent, do you contact the bank where the money was requested to go, so the bank can red flag the account? So Penny is...
We have done that on occasion, but most often we contact the client and help them to improve their security arrangements.
Okay, fantastic. So next question, and I'll stay with you, Penny, for this one as well. So it's a two-part question. So initially, what are your views on the operational and financial resilience requirements? And then, has your firm done any work in this particular area?
Yeah, it's an interesting question. So we're out of scope of the actual requirements themselves, but we consider that a lot of them are really quite sensible. And so we have been running a project to assess the FCA's new rules and guidance and to see whether there are ways that we can improve our resilience. So we've had a working group looking at that. We've been identifying our important business services, also liaising with key suppliers to understand how our interactions with those might affect our resilience or indeed their own, and mapping and working out impact tolerances. So for example, talking with our IT team to look at recovery time objectives. So what are the key systems? What are their failovers? What are the time to recovery for those? The next big step of that project is to work with the front office to get more of a client perspective on that. So are those recovery times reasonable? So IT might say to us, well, this key system, it would take 16 hours to recover, but is that going to be intolerable from a client point of view? And do we therefore need to do something different to try and get that up and running more quickly? The other thing I would just say is that we've been looking at BCP alongside this. For us, for a firm of our size, it didn't make sense to look at them completely separately. Although they're not the same thing, they come at it from a different angle. For us, it makes sense just to look at the two aspects together.
Thank you, Penny. Duncan, how about Canaccord? What are your views on operational resilience?
So I think it's got to be a good thing. I don't think anyone would argue with that. I think just a high level, this is one of those FCA requirements that allows firms flexibility, but with that we have this double-edged sword of uncertainty, and that's where the expert compliance departments come in to say what we should concentrate on. So it's a major regulatory risk. We've done the same as Penny. We have a group looking at it. We've identified, we're looking at harm to clients rather than harm to markets, etc.
Yeah.
So we've looked at third-party relationships, we've looked at our important business services, impact tolerances, we've done mapping, we have 8 test scenarios that we're looking at, and we've had to purchase a software system which ties all these things together. We've benchmarked our maturity, as they call it, on operational resilience. Worryingly, it's still lowish, but the good thing is for quarter to quarter it increases, and this is obviously a long-term project over the next few years. And just picking on third-party relationships, which Penny mentioned, we've sent out 101 DDQs to various people, which we have to send out, chase up, and assess. So that on its own is no mean feat. So there's a lot of work going on at Canaccord to ensure this happens, and that we meet all the requirements. And as I said, it's got to be a good thing to prevent harm to clients, but it's just another thing that we have to build into our budgets, resource, and involve. And it's another one that involves the whole firm essentially.
Thank you, Duncan. And Louise, what are your views on operational resilience?
Not that dissimilar, funnily enough, to Penny and Duncan's. I mean, yeah, you step back, it looks sensible. The thing that we found quite interesting, and we've got a working group, etc., the same as everybody else, is our initial cut of what we thought might cause intolerable harm to clients and what systems were key and what capabilities were key to that. We've recut that list several times. Your first reaction was, well, actually we need everything. Well, you can't need everything. So actually, if you really, really drill it down to what are the key things you need to do, it's really interesting. I think we've restacked that list several times, and we keep relooking at it and making sure that it feels appropriate and right. And I think Penny's right in that you have to. You can look at it from a kind of an operations perspective and through that lens, but it's also about, making sure you do think about from a client view, and front officers, it has a good view of that. I think one of the challenges, which I think kind of Duncan alluded to, is the FCA, the rules were published a year ago, 1 year implementation, which is, eminently sensible, but we have this additional period running to the end of March 2025 where we have extra time to do certain things. And when you have a multi-year project, it is sometimes difficult to maintain momentum, and therefore that's an interesting challenge where you get to a really good place and where you want to be for the 31st of March 2022, and you set kind of targets for where you want to be for the next kind of 3 years, but it is difficult to maintain that momentum at times where you have, it's good that we have some multi-year timelines, but it is also a challenge at the same time.
Thank you, Louise. No,
I'm not suggesting it be taken away, but I'm just saying it's a challenge when you have multi-year projects. It's an extra aspect that you have to consider.
for sure. Now, I'm just looking at the time. I'll make this the last question. Now, it's around price transparency. So first of all, do you think price transparency is actually an issue in this industry? And the second is sticking to charges. Given that the costs of compliance are going to be increasing, do you think charges are going to go up in order to fund those extra costs of compliance? And I'll start with you, Louise.
I think cost transparency, the industry has done a huge amount of work over the last, well, it's probably about 5 years, pre-MiFID, bringing in MiFID 2, etc. I think the industry has done a lot of work. I still think there is still confusion, especially around indirect costs and implicit costs. There is still a difference between how you calculate cost and charge under MiFID and how you calculate it under PRIPS. So I think there probably is more that can be done to try and, if we can align and have one way of doing it, wouldn't that be great? But that might be difficult to achieve. But I think we've come a very, very long way. On kind of whether the cost of compliance gets added on to the cost that the client pays, I don't think it's just about the cost of compliance. I think there are, compliance is one of many, many costs that firms have to bear in order to provide the service that we provide to clients. And firms have to look at those costs versus the income they earn and work out from a commercial perspective what they think their pricing structure needs to be. A compliance cost is one part of that, but it is just one part of that. So is there a direct link between compliance costs going up and the costs to the client going up? I don't think there is a direct link, but there is definitely, it's part of it, and that is what every firm will consider when they look at what their cost base is, where they can get economies of scale versus what they charge their client, and make an assessment as to whether or not the costs stay the same or go up. So it's one part.
Thank you, Louise. And Penny, what are your views in terms of cost transparency to start?
Okay, so on transparency, I think across the wealth management sector, I think we're probably pretty good at disclosing charges to our clients. I think we always have done. It's part of that relationship and that trust that we build with them. I do think the impact of MiFID 2 was to encourage us to simplify our charging structure. I think that's been a good outcome from that piece of regulation, that we have made it easier to understand and more transparent in that perspective. The different methodologies don't help in terms of clients being able to compare the charges of one firm with another, but I think within a particular firm, the disclosures are probably clear. But I don't think regulation has yet got to a point where it's easy for a client to weigh up the costs of one firm against another. If I could just pick up on the other point as well, James. So I agree with Louise. I don't think there is a direct correlation between increasing compliance costs and increases to clients, because I think all firms are all the time balancing increasing costs in one area and trying to reduce them through efficiencies or investment in technology in others. So it's possible, but I don't think you can say that it's going to directly bring on an increase in client fees.
Thank you, Penny. And Duncan, just to finish off with you. So what are your views on transparency, and is there a direct link, or do you agree with the other two panelists?
I agree with the other two panelists. I don't think we have a problem on price transparency. I think we've always, it's maybe being arrogant, but I think we've always been quite transparent in our industry on costs, and MiFID 2 has helped that. Although whether implicit costs help at all is a different matter, but that's a personal view. I don't think that makes it particularly clear. So I think we're okay on price transparency. I don't think the costs will be passed on. I think the cost pressures are too much the other way, in that we're all looking at reducing costs. So I don't think they will be added on to the client costs. But I think in terms of costs and value, the issue that we are going to look at in response to the CEO letter, and Therese mentioned it this morning, is fair value. And the service element of our proposition is something that we always say clients value, and we believe clients do value it. But we've got a bit of work to do, I think, on looking at fair value, and particularly where you look at that compared with other products as opposed to services. What is the value of that service? I mean, we think there is value there, but yeah, we need to do some work on fair value, I think, and that's probably the one area of the Dear CEO letter that we'll probably need to work on.
Thank you very much. Well, just looking at the time, I see we're at 12 o'clock now, so I will actually bring this panel session and for the webinar to an end. So thank you very much to all three of you for joining us on the panel. Thank you also for our previous speakers, Therese and Tom, for their presentations, and thank you to each of our listeners for logging in today. Now, we would be delighted if you would to join us at future events, and we've got here a couple of the ones coming up, and the big news for us is that for our Wealth Tech, that's at the end of April, we will be returning to a physical event, so following the government's guidelines. And so if you would like to attend, please do not hesitate to go onto the Compeer website and register for that. Obviously, it will be a limited number of spaces, so the quicker you are, the better. But if you can join us, fantastic. But on that note, I'll wish you all a lovely remainder of the day. Thanks again for logging on.
Thank you.